We've been going through months and months of fairly gloomy numbers out there, but finally there's a little bit of good news in the consumer sentiment category. I know some people call me red flag Mark because I'm always pointing out the potential downsides of what's happening out there. This is possibly a green flag that you might want to take a look at. The University of Michigan's Consumer Sentiment Index rose to 60.5 in June, and that's up from 52.2 in both April and May. And for context, that 52-week range was almost at a bottom. So this is a meaningful shift in an upward direction here. Now, economists here were only expecting a small bump to 53.5. So this beat the forecast by a very wide margin. Two key things improved in this survey. First off, the how people feel right now part of it. That's the current conditions. That went up to 63.7 from 58.9. Also, how do people feel about the future? That jumped to 58.4 from a very dismal 47.9. And this is the first positive move now in around half a year or so. So maybe people are starting to feel a little bit better, but we do have to remember that we're still 20% below where things stood in December of last year. So just 6 months or so ago, when there was a brief boost in confidence at that point after the US election. There's also a concern in the background, especially about the US tariff policies. And that kind of uncertainty still makes people a little bit nervous out there. Now, as far as inflation expectations are concerned, 1 year inflation expectations dropped from 6.6 in May to 5.1% in June. We also saw long-term inflation outlooks inching down to 4.1%, and that continues a downward trend. For retail investors, so this is us, this is pretty key because it does affect the Federal Reserve's next move or next series of moves. As of today, the odds are 99.9, so pretty sure that the Fed is going to hold its rates when it meets this Wednesday, and it's not until the September meeting that the odds are now showing a cut. But if inflation looks like it's cooling, the Fed might take this as a reason to start cutting interest rates again a little bit sooner than what those numbers are showing right there. Now, as for Canadian investors, this all matters. It's a U.S. number, but it does matter to us here at home as well. When we see a softer U.S. inflation picture, that could lead to a weaker U.S. dollar, which would then boost Canadian exports and resource stocks, again, all factoring in the tariff issues there. If we see that, we'll see improved demand for Canadian goods. U.S. consumers will start spending again, but it is a little bit of a wild card. So if you're holding U.S. ETFs or U.S. stocks, or even just companies that rely on U.S. consumers, then this report is a potential green light as opposed to the usual red flag. Now, I do think it's important that we do stay cautious here. The numbers that we're seeing the past month are better, but they're still low. We can look back to 2018 and see how we are in comparison to the past number of years, even with COVID and the market correction in 2022 being factored in. So confidence still probably is a bit fragile out there. A lot could change depending on what happens with these trade tensions or interest rates. Plus, keep in mind that these are preliminary reports. The final numbers might tell a different story. It is so an encouraging signal, and we haven't seen enough of those in the last little while. So if this rebound in confidence holds, if inflation does trend down, we could see a stronger second half of the year for the markets. For retail investors, that might mean opportunities to add positions, especially in certain value sectors or dividend-paying stocks that benefit from economic stability. I would say keep your eyes open, though. If tariffs heat up again, volatility could come screaming back pretty darn quickly. So what is your take on this? Do you see this as a sign to lean in, or are you just sort of staying defensive for the time being? Let me know what your thoughts are in the comments. Now, a second positive note in today's show, Canada's housing market isn't exactly booming, but May did bring a little bit of good news. Home sales, they were down 4.3% compared to last year. That's not the good news. This is the first time in over half a year that sales actually rose from the previous month. They went up 3.6% in April, not a huge jump, but at least it is enough to suggest that we might be seeing a little bit of a turnaround here. Now, Sean Cathcart, he's from the Canadian Real Estate Association, and he says that the markets could have started recovering earlier if it wasn't for all of the uncertainty that was caused by the tariffs that we've seen out throughout the course of the year. He says it's only 1 month of data and one car doesn't make a parade, but there is a sense that maybe the expected turnaround in housing activity this year was just delayed for a few months by the initial tariff chaos and uncertainty. So it does look like buyers are maybe starting to dip their toes back into the market after sitting out for the first part of the year. Now, also sellers, a little bit of selling activity is reappearing as well. Listings rose 3.1% in May. There are almost 202,000 properties on the market, and that's up more than 13% from a year ago. Now, even with that increase, though, listings are still a bit lower than what's typical for May, so the supply hasn't fully caught up yet. If you're shopping for a new home, you're going to like this. Prices have slipped as well. The average home in Canada sold for about $691,000 in May. That's about 2% roughly than a year ago. Realistically, though, affordability obviously is still a big hurdle for many. But with that slight uptick in sales, it could be a sign that things are slowly getting back on track for both the buyers and the sellers who are looking for a bit of a steadier market. Now, if you are a young person in Canada, if you're trying to land a job right now, you're not imagining it. It is very, very rough out there. Gen Z is facing the worst youth job market in the country has seen in over 2 decades. And there are several factors that are making things harder. Inflation, there's a flood of new workers, and then, of course, the shaky economy thanks to the trade war with the U.S. This chart compares the overall population growth rate to those aged 15 to 24, and you can see that divergence there. Now, in May, the youth unemployment rate in Canada was 14.2%. That is more than double than the overall employment rate, which was 7%. Now, when you look at returning students, specifically ages 15 to 24, the unemployment rate was 20.1%. And the last time we had that, excluding COVID, was 2009 and then 1999 before that. So we're at a level that we don't see very often. When you look at young men, returning students, the unemployment rate was 22.1%. For young women, that was 18.4%, both very, very high. If we just look back a little bit, not that distance in history, we did see sort of a brighter scenario right after COVID when all those restrictions were lifted. We saw companies there hiring at a pretty torrid pace. Young workers were the major benefactors of that. But that doesn't appear to have lasted. We saw interest rates jump, of course. We saw inflation spike, and then hiring cooled off. Now, Brendan Bernard, he is a senior economist at Indeed, and he says that the bump in hiring that we saw coming out of COVID realistically was unsustainable. He says, as things have turned back and employer appetite has fallen back down to earth, the youth employment situation has weakened. Now, for a lot of our Gen Y community, this could have long-term effects. Some grads, they're taking whatever jobs they can take right now just to pay the bills. And studies do show that starting your career during a downturn can lead to lower wages for years and years. And that is a trend known as wage scarring. So a lot of people are doing what they can right now, but it does feel like they're sort of stuck in a hard place while they're waiting for their real life to take off. That is a wrap for today's program. As always, I do appreciate you watching. We'll see you in the next video.